in this video, I'm going to talk about my proprietary said and done strategy, where I have taught hundreds of students make 5 figures per month. In case you're wondering, this is not a get-rich-quick scheme or some type of MLM gimmick. I started investing in boring stocks in 2011, and I was trained by a young hedge fund manager who was managing $50 million by the age of 24. And my team has done numerous market research on all the programs out there. With our own back testing and research, our team knows what strategy truly works in the long run and can help you preserve capital and generate consistent cash flow. With US Feds reversing their money printing policy, with historical high interest rate and more interest rate hike are coming, not only the retail investor are fearful, but the legendary investor Stanley Druckenmiller, who has never had a down year in the market, fears the worst has yet to come. Shopify, the most valuable Canadian multinational e-commerce company, continued to drift lower after a stock price drop in 80%. So the million-dollar question is, if there is no stock too big to fail, can we pick stocks to beat the market? For new people who does not know me, my name is Cody Ye. I'm a 7-figure real estate and stock option investing coach. I've been featured on TD Direct Investing and 70 plus investing podcasts last year alone. Let's start by discussing whether we can pick stocks to beat the market. Here are the top 20 companies by market capitalization in 1989. Out of the 20 companies, only 7 of them are not Japanese companies. 6 of them are American multinational companies, such as Exxon Corp, General Electric, and IBM. If we take a moment and guess how many of these companies are still in the top 20 today, would you guess 10, 5, maybe 1? The actual answer is 0. None of these largest companies in 1989 ever made it to the list in 2021. 5 of the top 6 are American companies. The second company, Saudi Aramco, is 95% owned by the country Saudi Arabia. And none of the 20 largest companies are from Japan anymore. And this is a reminder of how things can change with technology and how difficult it is for the top 20 companies in the world to stay at the top. US only occupied 6 of the top 20 countries in 1989, and 13 of them were on the list of 2021. And it shows that capitalism has worked incredibly well in America. The top company in 1989 has a market cap of 104 billion, and Apple is sitting at 2 trillion in 2021. That is a 20x multiple. It almost seems impossible that 30 years from now, a $2 trillion company will become $40 trillion. Now, if you're someone who you think you're not Warren Buffett or Charlie Munger, that you can pick the stock that will be at the top in the next 30 years, you can always look at S&P 500. S&P 500 is the best 500 performing companies in North America, where it continues to be rebalanced, so any company that are not performing will be phased out and any new up-and-coming company will be added to the S&P 500 list. Now, if we invest $100 in S&P 500 30 years ago, you will have about $2,600 as of 2021. That is a 25x return in 30 years. And now with S&P 500, you don't just pick a ship, which is compared to a stock, you pick the ship because S&P 500 has been rebalanced every year. And I promise I'm going to set and done strategy right after this, where our set and done strategy has helped our alumni generating 1.5 to 4.5% per month consistent cash flow. You no longer have to pick stocks, and you no longer have to hold on to the stocks during a market downturn. This strategy is based on S&P 500 index. You only need to spend 30 minutes per week, so that fits your busy schedule. And now let's have a quick refresher on our beginner strategy where we sell options on individual stocks. And this is the strategy where it allows you to agree to buy a stock you want to buy anyway at a discount price. And this allows you to get paid premium just like the casino owner or the insurance company. Here's an example on selling options on Apple stocks. When Apple was at $115, I agreed to own Apple at 108, and this insurance policy expires in 20 days. And because I'm the insurance broker, I got paid $227 premium upfront. And here are the two scenarios that can happen with this insurance policy. Scenario number one, if the Apple stock price stays above 108 by the end of 20 days, I get to keep all the premium of $227. I don't need to buy any Apple stocks, and I go and rinse and repeat and continue to sell more contracts. Scenario number two, if Apple stock price dipped below 108 by the end of 20 days, I still keep the premium of $227, but in exchange, I have to buy 100 shares of Apple at 108, which is a discount from the original price of $115, and because of the premium I receive of $227, the average price of owning Apple shares has become $105. And this is how you can get paid to agree to buy a stocks you want to buy anyway at a discount price. Now, I know you guys watching until now is like, Cody, so if this strategy is doing so well, why are you doing the said and done strategy? Now, the reason is because with the said and done strategy, since it's based on S&P 500, you no longer have to pick stocks. And this strategy allows you to collect premium without the downside of back holding stocks in a recession. Also, because it's based on S&P 500 index, there's a lot less volatility. Like we saw early on with the Spotify, where it dropped more than 80% in 1 year. S&P 500 only dropped 20% in the span of the last year. So this way you have a higher certainty and less volatility for your cash flow. With that being said, let's jump right into a real example. When I make this trade, the S&P 500 future index was at 3,782. I sold a put option with a strike price of $3,060. The strike price was 19% away from the index price at that time. And this contract will expire in 45 days. And I received 11.5 in premium because each contract controls 100 contracts, so I received $1,150. Again, there's some leveraging involved, so it's actually a 2-to-1, so truthfully, I only received $575 in premium. So there's two scenarios that can happen. Scenario number one is if the S&P 500 index stays above $3,060 by the end of the expiration day, I get to keep all the premium of $575 USD. Scenario number two, if S&P 500 dropped below my strike price of $3,060, first of all, the chance of S&P 500 dropping at 19% in 45 days, the chance is really low. Second, I can decide to just take a loss on this trade. Third, I can decide to roll this trade out to buy myself more time for the market to gain back its sense. But at the end of the day, I do not need to own any S&P 500 future options. It's a pure cash flow strategy. In summary, the difference between selling options on individual stocks or a said and done strategy is that in order to sell options on individual stocks, you have to have the money to own 100 shares of the stocks at any time, and you might be back holding during a recession. And really, truly, how do you pick the stock that can still performing well in 30 years? You're putting all the eggs in one basket because you might not be Warren Buffett or Charlie Munger. Now, whereas the said and done strategy will allow you to have a pure cash flow strategy based on one of the strongest index in the world, you don't have to pick stocks, you don't have to worry about earning reports, and you don't have to worry about the huge volatility in individual stocks. And of course, there's other key variables that you need to look at, such as delta, theta, expiration date, strike price, and all that nuance I'm not gonna talk about in this video. If you're interested in learning more about our said and done strategy, feel free to join our Facebook group with more than 4,000 like-minded investors, and I also run a Facebook Live every Thursday at 6:45 p.m. And you can also sign up for a newsletter where our coaches predict the short to medium term market direction for you. You can learn from there as well. So thanks for watching, everyone. If you find any value in this video, don't forget to hit that like button and subscribe to the channel, and I'll help you get a step closer to your own version of financial freedom. Say yeah.